This is part 1 of the presentation for Module 5 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In this module, we will examine how companies recognize revenue and account for sales returns and allowances, revenue paid in advance, and the effects of foreign currency exchange ratios. Next, we will describe the accounting for an analysis of accounts receivable and analyze the typical expenses in the income statement. We will then analyze reporting of discontinued operations, income attributable to non-controlling interest, and review pro forma income reporting. In this learning objective, we will apply the revenue recognition principles and assess results. This slide shows the income statement for Pfizer. Revenue or sales is the top line on the income statement, and it includes transactions between the company and its customers during the past year. Revenue does not include gain or losses on the sale of assets such as property, plant, and equipment, or investments, nor does it include interest and dividend income on investments, gains or losses on their sale. These items appear in different sections of the income statement. The amount of revenue Pfizer reports on the income statement is net of certain deductions, which are described in the revenue recognition footnote. According to the footnote, gross product revenues are subject to a variety of deductions, which generally are estimated and recorded in the same period that the revenues are recognized. Such variable consideration represents chargebacks, rebates, sales allowances, and sales returns from gross revenue. As we will learn in this chapter, the revenue recognition principle has changed the amount of revenue that companies report on the income statement if the revenue includes variable consideration, such as Pfizer mentions in this footnote. The new revenue recognition rules from the Financial Accounting Standards Board went into effect for financial reporting periods beginning after December 15, 2017. The new rules modify the way in which companies recognize revenue, but the core revenue recognition principles remain the same. Revenue is recognized when the company transfers a good or service to a customer, that is, when the customer obtains control of the goods or services. It is not necessary to receive cash to recognize revenue. Every sale involves a contract, whether express or implied, between the customer, whereby the company agrees to transfer a good or service to the customer and the customer agrees to pay for it. All that is necessary for the company to recognize revenue is for the good to be transferred or the services performed. It is at this point that the company's performance obligation is satisfied and revenue can be recognized. Many sales are on credit, meaning that the customer has agreed to pay the company in the future. The company still recognizes revenue when the good or service is transferred to the customer, and it records an accounts receivable that it will collect in the future. The recognition of revenue is unaffected by the delayed receipt of cash if the company has fulfilled its performance obligation. Under the new revenue recognition principle, there are 5 steps that companies must take to determine the correct amount of revenue to recognize. On this slide, we have the first 3. First, the company must identify the contract with the customer. The parties to the contract should be identifiable, and the terms of the sale should be specified, including the items sold, the delivery terms, and the payment required. The next step is to identify the performance obligations in the contract. A performance obligation is the company's contractual promise to transfer a good or service to the customer. If the contract involves a transfer of more than one good or service to the customer, the company needs to account for each promised good or service as a separate performance obligation and recognize revenue separately for each. Next, the company must determine the transaction price. If the purchase price is variable, which means that it is dependent on contingencies, the company should estimate revenue using the expected purchase price. This is the step that Pfizer was referring to in their footnote to the financial statements, and we will cover this later in more detail. The fourth step is to allocate the transaction price to the performance obligations. For contracts that have more than one performance obligation, the company must allocate the transaction price to each obligation at its fair value. That is, the standalone selling price of the distinct goods or services underlying each performance obligation. If published standalone prices are not available, the company must use a reasonable estimate of the selling price. The last step is to recognize revenue when each performance obligation is satisfied. Companies should recognize revenue when the customer obtains control of the goods or services. This will generally be when the company transfers the goods or services to the customer. Performance obligations that are satisfied over a period of time should be recognized as revenue over time. In retail settings, revenue recognition is straightforward. Revenue is recognized at the point of sale. The customer takes physical possession of the purchased goods, and the store immediately satisfies its performance obligation. In other settings, it can be more challenging. On this slide are some of the more complicated revenue recognition situations. If a company has non-refundable upfront fees, then the fee is an advance payment for future goods or services, and therefore would be recognized as revenue when those future goods or services are provided. Bill and hold arrangements arise when a customer is billed for goods that are ready for delivery, but the company holds the goods for shipment later. In this case, revenue should be recognized when control of the goods transfers to the customer. For consignment sales, if the seller acts as an agent for another company, such as Priceline does for car rental companies, Priceline should only recognize revenue for the commission that it makes on the sale and not for the gross amount of the car rental charges to the customer. Software sales often involve licensing arrangements. Revenue recognition will depend on whether the arrangement confers a right to use the intellectual property or provides access to the company's intellectual property over time. Franchises who sell both goods and consulting and other administrative services should separate the sales into the separate components and recognize the appropriate revenue for each component as the goods or services are delivered. If a company has revenue that depends on future events, they can only recognize currently the amount of revenue that is likely to occur, and that can be reasonably estimated. If there are multiple products that are sold in a bundle, then the components must be identified so that each one can be separately valued, and then revenue is recognized as a company satisfies each of the performance obligations. Retailers typically offer a right of return if the customer is not satisfied with the product. Companies estimate the dollar amount of goods that are likely to be returned and deduct that amount from gross sales to arrive at the net sales reported in the income statement. When cash is received from the customer for a gift card, the company records the receipt of cash and a deferred revenue liability. Then revenue is recognized when the gift card is used by the customer to purchase goods or services or when it expires. Many companies enter into long-term contracts that obligate them to future performance. For these types of contracts, companies must determine the point at which their performance obligations have been satisfied so that revenue can be recognized. For a multiple-year contract, waiting to recognize revenue until the good is delivered would be problematic because the expenses of constructing the product would be recognized as incurred, whereas the revenue would only be recognized at the end of the contract. An accepted practice for many years has been to recognize revenue over the life of a long-term contract in amounts that track the percentage of completion of the contract. Companies typically use the percentage of projected contract costs that have been incurred to estimate the contract's percentage of completion. This method is called the cost-to-cost method and is the most common. The note disclosure shown for Raytheon, a U.S. conglomerate specializing in aerospace, defense, civil government, and cybersecurity, describes its revenue recognition practice. To illustrate accounting for long-term contracts using the cost-to-cost approach, assume that Raytheon signs a $10 million contract to develop a prototype for a defense system. It is estimated that the construction will take 2 years and cost $7.5 million. The contract yields an expected gross profit of $2.5 million. In year 1, the cost incurred totaled $4.5 million, which indicates 60% of the contract is complete. Multiplying the revenue of $10 million by 60%, we determine $6 million of revenue should be recognized in year 1. In year 2, the contract is completed and the remaining revenue of $4 million should be recognized. This slide shows the recognition of revenue and expense over the 2-year period. We see that Raytheon recognized revenue for $6 million in year 1. The accumulated costs to date on the contract were $4.5 million. Therefore, there was a gross profit on the contract of $1.5 million in year 1, reflecting the difference in revenue of $6 million and cost to date of $4.5 million. In year 2, the remaining cost of $3 million are recorded and the remaining revenue of $4 million is recognized, yielding gross profit of $1 million. This slide illustrates the revenue and expenses that were reported in year 1 and year 2 for the contract and the resulting gross profit. How Raytheon recognizes profit on long-term contracts affects its income statement. In addition, there are timing differences between when contract costs are paid and when the customer is billed for work performed. These timing differences affect the balance sheet. Raytheon describes the accounting for those timing differences in the footnote shown on this slide. When Raytheon receives cash in advance of incurring costs under a contract, it records a liability that represents the obligation to deliver the product for which it has been paid. When Raytheon incurs costs to construct a product in excess of the amount billed to the customer, it recognizes the excess as a current asset. Contracts in process, as illustrated in the slide showing the current assets section of Raytheon's 2018 balance sheet. There was widespread concern that the new revenue recognition standard could significantly impact a company's reported financial performance. To address this, PwC surveyed more than 700 finance executives to learn details about the impact, asking them if they expected the new revenue recognition standard to have a material impact on their company's income statement and/or balance sheet. While the new standard's impact varied by industry and was high for some companies with licensing or complex revenue arrangements, the overall impact was not expected to be material. However, the impact extended beyond accounting. Consider the responses to the question concerning how difficult it was to implement the new standard in the areas shown. Also, an important characteristic of financial statements is comparability. By adopting the new standard, companies changed how they measure revenue beginning in 2018, thereby impairing the comparability of the 2016 and 2017 numbers reported in the 2018 income statement. To avoid this, companies could choose to restate all comparative numbers shown on the 2018 income statement, but were not required to do so. In this learning objective, we will analyze sales allowances. Many companies offer customers a variety of sales allowances, including right of return, sales discounts for volume purchases, and retailer promotions. Sales allowances are especially prevalent in industries with undifferentiated, commoditized products such as the retail clothing industry in which Levi Strauss operates. GAAP requires companies to report sales revenue at the net amount the company expects to receive. This means companies are to deduct from gross sales the expected sales returns and other allowances. For example, Levi Strauss reports in the note disclosure to their financial statements that they recognize allowances for estimated returns in the period in which the related sale is recorded. They recognize allowances for estimated discounts, retailer promotions, and other similar incentives at the later of the period in which the related sale is recorded or the period in which the sales incentive is offered to the customer. This slide illustrates how Levi Strauss would record the allowance for sales returns. Assume that Levi Strauss sells jeans costing $80 to a customer for $130 on account. Levi Strauss recognizes $130 as revenue and $80 as cost of goods sold. Because they have offered the customers a right of return, and because prior experience leads the company to expect that returns will occur, Levi Strauss must also set up a reserve for estimated returns. Let's assume that they expect returns to amount to 3% of sales. They would record an allowance for sales returns equal to $3.90 or 3% of the $130 sales revenue, and record $2.40 or 3% of the $80 cost of goods sold as estimated returns. These amounts would flow through the income statement and eventually be reflected in retained earnings. Net sales revenue would be $128.10, the gross sales revenue of $130 minus the estimated returns of $3.90, and cost of goods sold would be $77.60, the gross cost of goods sold of $80 minus the estimated returns of $2.40. Thus, the gross profit after allowance for sales returns would be $48.50. Levi Strauss provides a reconciliation of the beginning and ending balances for the past 3 years for its allowance for sales returns and for its sales discounts and incentives in its 2018 10-K. This is a typical disclosure for companies with sales returns, discounts, and other sales discounts. We will analyze this information to determine the effects of sales allowances and discounts. The analysis of sales returns and allowances includes the additions charged to net sales compared with gross sales for sales returns and sales discounts. This ratio reveals any effects of the pricing pressure on net sales, and we would expect the percentage of sales allowances to gross sales to increase as pricing pressure increases. Allowance as a percentage of gross sales is another ratio measuring the balance sheet amounts and is analyzed for trends. Last, the adequacy of the allowance account analysis compares the dollar amount that is estimated for future sales returns with the actual amount realized during the year. If the company estimates are 100% accurate, the two amounts will be roughly the same, with some variance due to sales and returns that cross a fiscal year end. If the amount charges to sales is greater than the cost incurred, the company has reduced sales more than is needed and has reduced its profit accordingly. If the amount charged to sales is less than the cost incurred, the company has under-reserved the allowance account, thus increasing profit. This slide shows the analysis of sales allowance for Levi Strauss for the 2016 through 2018 periods. The first ratio compares additions charged to net sales with gross sales for both sales returns and sales discounts. over the 3-year period, Levi Strauss has reduced the sales returns and discounts given to customers from 10.3% to 9.8% of gross sales. The company attributes this favorable trend to an increase in its direct-to-customer channel. They state that sales direct to customers generally have higher gross margins than sales through third parties, although these sales do typically have higher selling expenses. The second ratio of allowances as a percentage of gross sales shows that the allowance balance has fluctuated over the 3-year period, increasing fairly significantly in 2017, but returning to prior levels in 2018. For the third ratio, adequacy of the allowance account, there seems to not be much concern for Levi Strauss's allowance account, as the ratio is near 1 for each year, with a moderate amount of variation. We would conclude that Levi Strauss is accurately estimating sales returns and discounts. Each period, managers must estimate expected sales allowances using the most complete and accurate information available at the time. Although sales allowance numbers are audited, it is still possible for the managers to pad or shave their estimates to help the company meet net sales or earnings targets. If the ratio of additions charged to gross sales has varied over the 3-year period and the variance seems unreasonable, analysts might determine the average over the period and adjust each of the 3 income statements and balance sheets to reflect that average. To adjust the financial statements, we would calculate the difference between the unadjusted and adjusted additions charged each period and carry that amount through the accounts. This slide illustrates the Analyst adjustment for Levi Strauss for additions charged to gross sales. First, we would calculate the average ratio of additions charged to gross sales by summing the total additions and total sales for the 3 years and divide the total additions by the total gross sales to determine the average. Then we would apply that average amount to determine the adjusted additions charged and adjusted sales as shown on the slide. Next, we would carry the adjusted numbers through the income statement to determine the adjusted net income after applying the statutory tax rate of 22% in all 3 years. Last, we would use the adjusted numbers to restate the balance sheet for the 3 years. Note that the 2018 balance would not change, as it represents the accumulated amounts over the 3 years and would therefore be correct. Only the 2016 and 2017 balance sheets would require adjustment. Alternatively, we could use the balance sheet allowance totals at year-end as a percentage of gross sales to make the adjustment. We can use any number of years to calculate a steady state average as long as the economic conditions of the firm are in steady state during those periods. In this learning objective, we will analyze unearned or deferred revenue. In some industries, it is common to receive cash before recording revenues. Customers might pay in advance for special orders, make deposits for future services, or buy concert tickets, subscriptions, or gift cards. In those cases, companies must record unearned revenues and only record revenue when those products and services are provided. Specifically, deposits or advance payments are not recorded as revenue until the company performs the services owed or delivers the products. Until then, the company's balance sheet shows the advance payment as a liability. Unearned revenue is particularly common among retailers that receive advance payments from customers for goods that are not yet delivered, sell gift cards, and sell extended protection plan contracts. Lowe's Company, the home improvement company, provides several examples of transactions that require revenue to be deferred, as illustrated in this excerpt from the revenue recognition footnote in its 10-K for the 2018 fiscal year. As we evaluate profitability for companies that report substantial amounts of deferred revenue, we must be aware of changes in deferred revenue liabilities on the balance sheet. Should deferred revenue liabilities decrease, we infer the company's current reported revenue was collected from customers in a prior accounting period, and there have been fewer new prepayments for which revenue will be recognized in future periods. Such a trend could predict future declines in revenue and profit. As the analysis for Lowe's shows, they have increasing deferred revenue for extended protection plans over the 2016 to 2018 period. Therefore, we would have no reason to predict future revenue declines. And this is the end of part 1 of the presentation for Module 5 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.